Good morning and good afternoon. Sorry, I keep forgetting. I am in Los Angeles. So welcome everyone. Welcome. And probably see Brian's face. We're very excited to chat with you today. So as you guys log in, great way to get to know each other. Tell me actually where you are joining from. So I'm in Los Angeles and Brian, you are in?
New York.
New York. Yes, he is in New York. So how can you share? There is a chat box on your screen. So if you just drop in the chat box, actually I'll start us off. And just tell me where you are joining from. That'll be a great thing to get to know you. Oh, Portland. Hi, Portland. And we have another New Yorker, Red Bank, New Jersey. Okay. Denver. I love Denver. Oh, I love Denver. This is all starting to make me miss traveling all of this very moment. Menlo Park. Hello. Hi, Gwen from Chicago. How's it going in Chicago? Got Jason from Boston, Daisy in San Antonio. Oh, this is really, we are all over the map today. Usually Brian, it's usually like 2 main cities, but today, like, we're everywhere.
People have more time on their hands.
You know? And they're using it wisely. I love that. I love that. Hello, everyone, guys. I'm just going to give you maybe like 1 more minute before we get started and kick off our topic. And I'll introduce you to our guest today. So for this next minute, since you've already told us where you're joining from, why don't you give us a 1-sentence pitch of your business? Tell us your business name, and then 1 sentence of what your business does. So you can also drop that in the chat box. I love the chat box. You can drop that in the chat box. Just 1 sentence, just say the name of your company, and then 1 sentence about what you do. That'll help us understand what kind of people we have in the room today, our virtual room. Hoboken, New Jersey. Hoboken is so beautiful. It's a beautiful. I used to live in New York. I didn't tell you that, Brian. I used to live in New York.
Oh, yeah?
I lived in Brooklyn for 9 years.
Oh, amazing. Where in Brooklyn?
I lived in, what is it called now? Jesus. They changed the names. It's not Prospect Heights. It was off of Nostrand and Sterling Place.
Yeah.
Oh, you know.
I know what you're talking about. I'm not sure which neighborhood it is.
I'm like, what is that now? But yeah, I love Brooklyn. I did live in Harlem for 6 months, but it was too much. Hi, Peter from Chicago. So we have an e-search for marketing, custom design marketing research project. Welcome. And then we have a yet to exist company with some ideas on blockchain and crypto. That's really cool. Blockchain is always a huge topic. Closet Melody, a digital personal styling and shopping app. Could definitely use that right now since we're all in the house. And then we have Jean Bergala from Code Scholarly. We work with school districts by providing coding programs. That's really cool, guys. Hi, Greg from San Francisco, co-founder of Polyscribe. Awesome, thank you for joining. Taylor from The Herd Company. We're paving the way for fabric made from agricultural waste based in Los Angeles. Awesome, that is a really cool company. Awesome. All right, so why don't I go ahead and you guys can keep sharing, you can keep connecting with each other. I'm gonna go ahead and share my screen so I can get us started for today. So as you know, this is our Meet the VC. First of all, I want to say thank you so much for joining us online. These events usually take place in person, but now that we're online, we can reach so many more people, and I love that. So today we're going to be with Brian Yormak of Story Ventures. We're excited to talk to him. So a little bit about me. I am an entrepreneur, also a writer. You can find some of my writings in the Green Guide on earlygrowth.com. And a fun fact about me, I did write a book in 2016. So if you need a good book to read, you can find me on the internet. Today's webinar is going to last about 40 to 60 minutes. We will include a Q&A. So how do you ask your questions? You can ask them anytime during this webinar. You can just drop your question in the Q&A panel. If you happen to put it in the chat box, don't worry, I'll try to grab it from there, but just drop your question in the Q&A panel at any time. We'll try to incorporate it in the conversation. If not, we'll get to it right at the end, those last 20 minutes. This is being recorded for all of you who are wondering. If you registered for today, this is being recorded. It will be available on YouTube, and we will send you a copy of this presentation within 48 hours. So let me tell you a little bit about early growth. So I know most of you have been up here before, but if you have not and you don't know us, so what do? We love working with early stage companies. We help them with their financial and accounting needs. If you're not quite ready to onboard a full-time CFO, you can have a part-time CFO through early growth, but with the expertise of a full-time. Our CFOs have 10, 15, 20 years of expertise, and they have worked in various sectors. So if you're looking for someone like that to join your team, please reach out to us. So again, what do? The 4 buckets: finance and accounting, taxes. It is tax season. We can definitely help you with that. Equity management. We also work with investors with their fund accounting. So a little bit more about us. We have been in business for 11 years. We've worked with companies in 40 plus countries, and we've helped raise $2.5 billion. Some of these companies you may know, like Stitch Fix, Crunchbase, and HelloSign. And today is the deadline for our tax promotion. If you still are looking for someone, an expert to do your taxes, you can take $500 off of your C Corp taxes if you sign up today. And you can do that by going to earlygrowth.com/tax promo. And I have to give a special thank you to our partners today. I want to give a thanks to TriNet. You are always such a great partner to us, so thank you for joining us today. TriNet provides businesses with HR solutions, including payroll, benefits, risk management, and compliance, all in one. Thank you so much, TriNet. And then we also want to give a special thank you to our other partners, Pacific Western Bank and Cooley. We appreciate you so much for helping us with these events. You've been a great help for us. And then to our special guest today, Brian. So Brian is a VC at Story Ventures. He focuses on, his interest is in everything that touches logistics, transportation of people and goods. And a fun fact that I found out about him, he is a former fellow of Venture for America. Hello, Brian.
Hey, how you doing?
All right, so let me stop that share. So let's get into the questions for today. So I just did a brief intro of you and what you focus on, but could you just tell us more about what you like to focus on with Story Ventures? What kind of companies?
Yeah, and if it works, I'll just give a quick background to frame that a bit. So my background, I started out in investment banking, and then I moved out to Detroit to join a venture capital firm called Fontinalis, which was started by Bill Ford, who's executive chairman of Ford Motor. And so I was focused on the broader world of smart transportation. So things like autonomous vehicles, connected vehicles, robotics. Had an incredible experience there, and decided that I wanted to go off to start my own firm. So in 2016, went off to do that. And the thesis and what we focus on came largely from my focus on autonomous vehicles. So I'll try to keep this brief, but I think it's interesting as framing. So when you think about an autonomous vehicle, depending on your familiarity with the technology, there were really 3 large technological shifts happening. One was at the data capture layer. So how do you think about using things like cameras or radar or LiDAR to capture data from the real world? The second was improvements in kind of the brains or the middleware of the car, which was movement from on-prem computing to cloud computing, improvements in microprocessors. And that meant that we could store, process, and organize more data. And then lastly, we had improvements at the AI layer or the algorithmic layer, which meant that we could actually have more insights from that data. And so we were combining creation of data with organization of data with eventual application. And that's what was making autonomous vehicles possible. But to me, I thought that that data stack was going to be way more applicable to a variety of industries. And so that became the focus for Story Ventures, which is let's look at companies that are thinking about kind of the modern data stack and how to create data in new ways, organize it, and build on top of it in a variety of sectors. And then last note is within that, for Story in particular, we spend the most time in transportation and logistics, given my background, and then healthcare and finance and a bit of consumer as well. So that's kind of how we got to where we are today.
I love that. And I wanted to ask this question: where does the name Story Ventures come from? Why Story?
Yeah, it's a good question. So for anybody that's created a company, you toss a ton of ideas out there. So a lot of it was just kind of like throwing a dart at the wall and just brainstorming concepts. But I think a bit more context, I started the firm with one of my brothers, Jake. He was previously a lawyer. And when we were thinking about what was important to us in terms of the brand we wanted to build and the entrepreneurs we wanted to work with, we realized that we definitely over-index for communication. And so when we think about entrepreneurs, one of the things we're always looking for is their ability to communicate and their ability to tell a story and their ability to craft a narrative both for today and what the business will look like. And so we think story, or the ability to tell a story, is kind of essential, especially for early stage entrepreneurs where there's no business, right? There's no revenue. So it's really convincing the world and the people you hire that there's a story worth getting aligned around. So that was kind of the impetus there.
I love that. And I'm assuming that when it comes to logistics, that is male dominated. So how do those stories come across as clearly as they need to be? Because,
yeah,
it doesn't happen.
No, it's a really good question. I think especially for a lot of the industries we look at, particularly in transportation and logistics, it's like very old school, male dominated, because that's just what happened 10, 20, 30 years ago. I think what's really nice to see is that there are a number of entrepreneurs, female entrepreneurs in particular, that I think actually bring some fairly fresh perspectives. So I was just speaking with a MBA at Wharton, and she worked at Macy's. She ended up moving towards the supply chain aspect of Macy's and recognized how much of a gap there is in that world. And so it's really exciting because I think people, at least investors in my mind, are increasingly open to the narrative that you can use fresh perspective in order to really change the industry. I think what will be interesting to see is like how accepting the industry actually is, right? Because they need to be able to sell a solution into that market. So that'll be really interesting. But I mean, even if you think about companies like Away, two co-founders, female, Steph, the CEO, her whole background was in supply chain and logistics, right? And like was able to bring a combination of that supply chain knowledge with kind of like a modern design aesthetic. And so you see these new concepts and new ideas emerge from seeing kind of an increased introduction of female entrepreneurs. It's definitely early days, but it is interesting to see what to me feels like positive momentum in terms of opportunity and the folks getting involved.
Yeah. And before we continue, I just want to remind everyone, if you have questions, you can drop your question in the Q&A panel and we will get to it. We'll try to incorporate it into the conversation, or we will get to it right at the end, those last 20 minutes. So let's also get to how you like to invest. So what stage do you invest in? What does the check size look like? And can the company be a non-US company?
Yeah, great question. So we target what we consider to be pre-seed and seed. So I think easiest way to define that is we're looking for companies that are going to be valued at less than $10 million post money. So that usually means that it can be anything as early as like just true idea, and that falls into the pre-seed bucket, or some initial product and some initial inkling of interest, but not like that true product market fit where it's basically like throw dollars to sell. It's still trying to figure out go-to-market strategy, what that looks like. So that's where we sit for the most part. And usually that's first institutional capital in. In terms of the checks we write, so we target 10% ownership in companies. That means that we're usually leading or co-leading, but we're not taking the whole round. So if you think about a $2 million raise on a $6 million pre, $8 million post, we're looking for 10% of that. So we're going to invest $800K, and then we'll usually help to build out that syndicate. So for the most part, we're taking like 30 to 50% of the round and leading. From an investment perspective, geographically, we focus on the Northeast and Midwest. Rationale is we've looked at international companies, but candidly, we work pretty closely with entrepreneurs we invest in. And it's just easier at the early stage to be close to those people, right? Like you want to be able to grab a coffee, sit down with them for a few hours just to brainstorm. And it's harder if you're not in the same place. It's not prohibitive, but we just prefer it in terms of being able to help. And last thing I'll say around that is because we like to work closely with entrepreneurs, we actually only invest in 12 to 15 companies per fund. So that's pretty concentrated for a seed fund. Again, rationale being like we don't have the bandwidth to support 10, 15 entrepreneurs each. And so we try to keep a concentrated portfolio so that we can be pretty hands-on within the geographies that we focus on.
Love it. And I have a question here from, I think it's Richard. He says, are you seeing more action in established data stacks or in Internet of Things / 5G kinds of self-directing supply?
Yeah, it's super interesting. What I would say is that I feel from a commercialization standpoint, there's still plenty of opportunity in kind of like the pre-existing data stack. So interoperability companies like the Plaids of the world that are dealing with already, I'll explain for people that might not know Plaid. So Plaid was acquired recently by Visa for $5.3 billion. They're basically the middleware layer between all the banks and any financial applications. So if you use Venmo or Square Pay or whatever it is, if you sign up and you type in your Bank of America information, when you do that, Plaid is basically providing the data from your banking partner. And so they're that middleware layer. And I think for us, what we see is that there's a lot of value today in interoperability of data. So there's a ton of data, like all your banking data, but it's not really accessible. And so we're seeing a lot of companies that are working on making data more accessible. I think in terms of 5G and IoT, there's still a lot of infrastructure that needs to be built, right? So like there's all of the hardware companies, the Qualcomms, the Verizons of the world that are fighting to launch and get nodes out there for 5G. But to me, I view that more as enabling, which is I think a lot of things will be built once 5G is in place. And the opportunity, though there is opportunity, is not maybe as substantial in our minds until that network and that ecosystem actually exists. Last thing I'll say is that I think IoT is increasingly interesting, which is that as I sit in a room, like for the most part, things aren't connected around me. And I do think we're in a wave in time where we're going to have more connected physical infrastructure. And so I do think that IoT is closer in my mind than 5G in terms of some potential near-term use cases.
So I want to get back to, well, not get back to, actually, I want to talk about COVID-19, or that's on everyone's mind.
Yeah.
And because you are in logistics, that's probably one of the sectors that gets hit, the worst. So what would be your advice for anyone in that space? How could they manage their cash burn and runway at the time?
Yeah, it's a really good question. So there's obviously not like a one size fits all here, right? Everybody's in a different situation. It's difficult for everybody for a variety of reasons. What I would say generally, like at the highest level, is that the folks that are most impacted today are folks that are later stage companies that have significant burn and were somewhat dependent on revenue and revenue growth to offset that burn. And so for companies that are in physical retail, if nobody is shopping in their stores anymore and they're burning a ton of capital, they're at very high risk. For companies that are in the physical world, retail, hospitality, travel, very similar things, right? Which is that your revenue is dropping probably almost to nothing. And so managing burn becomes really important. So for companies that are later stage, I think the reality is you need to find either really good capital partners that can support you and believe that you can come through this on the other side, or you have to think really critically about the team makeup and what that looks like and how you can manage that over the next few months. I think one thing that's really important to follow are just like all the stimulus packages coming out from the federal government, which is what can you take advantage of? How can you manage that? So those are for the companies that I think are going to be in need of cash in the next probably like 6 to 9 months. For other companies, earlier stage companies or companies that don't exist within that world, I think it's probably better to be safe than sorry, which is if there's capital around the table that's not incredibly dilutive, that you trust the capital sources, it might be worth taking in some extra capital now, even if you don't need it, just because we're still in a period of unknown in terms of how long this is going to last and what it's going to look like. What we are suggesting to founders we've invested in is, hey, we have capital reserved. It's here if you want it. We suggest that you think about taking some in, but it's really only if you think you need it. And then the last part of all this is like this is an incredibly hectic, difficult period of time, but the world is changing, right? So I think it's important to think about your business and what this will all look like as hopefully the world normalizes and where your business fits into that. So I think what we've been discussing with entrepreneurs we've invested in is like first and foremost, take care of yourself, take care of your family, take care of your friends, do what you can to help. When you're thinking about your business, think about what you want the message to be when we come out of this, and use the next month, 2 months, 3 months where you can't really sell anyways to build towards that, right? So start building product towards that, start building your marketing messages towards that, and don't try to sell now because people, it could be considered rude to do so while everything's going on. But start thinking critically about what you want your message to be a few weeks out, a few months out, because there will be hopefully opportunity to help the world in a meaningful ways as we transition out of this. And so that's kind of the message we're relaying.
And I really like that. And I like the focus on take care of your family, take care of yourself, your health, and then, prepare for the next, I guess, opening of opportunity.
Yeah.
So I know you just talked about helping the companies that are already in your portfolio, if they need another round of funding, but are you taking on new companies? Are you investing in new companies at this time?
Yeah, so I don't know, for whoever's on Twitter or VC Twitter, I think a lot of people are saying like business as usual, right? I think there's a range of impact on funds. My sense is that for larger funds or later stage funds, they're really focused on the current portfolio because there's more variability within the portfolio. They recognize that they need to help their current portfolio in significant ways and or just like manage the overarching fund because of how much exposure they have. For funds of our size, so our second fund is 25 million. We launched it last year, so companies are pretty young. We're actually somewhat insulated from the risks because most of the companies aren't burning an insane amount of capital. So there's not that much near-term risk, which means we actually do, and we still have 70% of our fund to deploy, which means we have capital to deploy. We have a certain amount reserved for current portfolio, but we also have plenty reserved for new investments. And because some of the larger players are rightfully so distracted with managing their current portfolio, there actually is a theoretical opportunity in the market, I think. So we're aware of that. What I would say is that there's this like external, very significant event happening. And so as much as I want to say like we're business as usual, we are being pulled in way more directions than we would be normally. And so we're definitely open to making new investments, but candidly, we don't have the bandwidth that we did 3 months ago to do so. So I think we're being that much more careful about the calls we're taking, the amount of time we're spending with prospective investments, and the likelihood of getting there. So I wouldn't be surprised to see us deploying new capital in the next few weeks, the next few months. But I think it's important for everybody to know that in the same way that you're being pulled in more directions because of what's happening due to personal or professional things, that's every industry, every person. And so bandwidth, I think, is kind of limited across the board.
Yeah. And then to add on to that, I have a question from Sanjay. Thanks for this question. He said, are you thinking about investing in companies where you may not be able to grab a coffee physically.
Yeah. So this whole like, will we invest in folks that we don't meet? Like, what does the remote investing look like? I think the answer is yes. Everybody has their own biases here. So we're definitely of the mind that we're building deep long-term relationships with these people, and we're the type of people that like meeting people in person and think that there are things you can pick up in person that you can't necessarily digitally. And so we do factor that in, right? Which is like, ideally we would like to meet people in person. The reality is that in this environment that is like literally not possible today. And so if that's the case, we factor it in, and it plays into the fact that it might be a little harder to get something over the line today. But as long as I can have a conversation with an entrepreneur, which is like, look, this is a concern for us. How do we get around this? How do we resolve this? And how do we talk through this? We definitely would. The one note I'll make, because I don't know where folks are based here, but we increasingly invest very little on the West Coast, San Francisco specifically. Reason being, there are a lot of really talented investors out there. We don't exist in that market. And we think there's plenty of opportunity in the Northeast and Midwest. So this has nothing to do with the current environment. It's more just that we don't really spend time on the West Coast in particular, more San Francisco in particular. So that's just a note in case folks are out on the West Coast.
I'm not hurt. It's okay. And for those companies that are trying to become part of your portfolio, are you looking for anything different in their pitch that you weren't looking for before? Do you need more traction now? Do you need a different type of KPIs? Like, what would sell you on it now than different just a few weeks ago?
Yeah, it's a great question. And I think everybody will give a different answer. My answer is, we're not actually looking for anything different, because what we're always looking for is how thoughtful is the person around why now is the right time to start that company, right? That held before COVID, that holds now, which is basically, if you're building a company today, it shouldn't be that you're changing it because the market has changed, right? So like the pitch to me today should be like, hey, given that COVID is happening, we think that there's going to be an acceleration of companies that care about having healthcare on demand for their employee base, right? And like, we were planning on this before, we believed in that business before, but today we think it's even more powerful. And so I think it's factoring in that, like, with this happening, there are going to be mid to long-term impacts of it. And maybe it does affect your business, maybe it doesn't. If it doesn't, I don't think it necessarily needs to change your pitch. I am hopeful that the market will not expect you to have higher levels of revenue or whatever it looks like. I think it's just that for companies this impacts, and I think there's a large number of companies this will impact positively or negatively. It's important to address it because like there are real implications. So it's more just figuring out how you think it impacts you for the positive or negative and framing that narrative, but not the one note is like, it doesn't have to affect your business. So if it doesn't, you don't have to factor it into your business, right? You don't have to make a big deal of it just from the lens of your business if you don't think that there are significant implications.
Yeah. Brian, I think you're getting a few invitations. Mike said he's in San Jose. They are not in San Francisco.
Yeah.
I got to come in. Have you been to Portland? So I think you got a couple of there.
I love the West Coast. There are just too many good investors, and I'm all for it. San Jose, Portland, those all work for me.
So once you do make an investment, you talked a little bit about this already. How do you like to work with those companies? Can you talk about the product market fit and go-to-market strategy?
Yeah. So I think that there's like the tangible and intangible. So the tangible is my partner Jake was a lawyer, so did large corporate law at a firm called Cravath, and then moved to a firm called Gunderson to work with the tech and venture ecosystem. My background was in investment banking and then as an associate at a venture fund. So I've done a lot more on the financial side. So the tangible stuff is, as you think about company formation, data contracts, financial modeling, those are all things that we can help with in the early days. The reality is that anytime before product market fit, a lot of the work is just like talking through ideas and concepts and thinking about how you want to take your product to market and thinking about the most critical hires based off of your gaps. And so what I would say where we add the most value is really in being kind of a thought partner in the early days, which is that we're speaking with entrepreneurs we invested in at least once a week, usually multiple times a week. And it's just things happening in the business and how to think about what the best path to a potentially near-term scalable product is before you start scaling. Because once you're really building product for specific customers, you end up getting somewhat locked into that, right? And so what you want to be really diligent about is before you do that, does this feel like the right path as your first step? I think even with what's going on with COVID, one of the interesting things is we've been pushing entrepreneurs to spend time doing market research and product development because you have this interesting gap in time and opportunity. So a lot of time spent to just thinking through, making sure that the narrative is super tight around what you're building, who you're selling to, and then doing a lot of early testing and talking through that before you hit product market fit. And then usually what happens is when that happens, a Series A investor will come in, they'll step on the board, they have a whole different set of resources and skills. And that's usually when we'll start to take more of a backseat, which is where there is a confidant and a friend and for whatever you need, but you're kind of at a different point within the life cycle of your business where you really need scale in a way that a smaller organization doesn't have necessarily all the resources you need. So our focus is kind of from like start to product market fit. And then we still exist as a resource, but then you're relying on often larger folks.
Yeah. I have a question from Manuela. She says, Brian said the world is changing. One big area is the climate, which consumers are increasingly aware of and concerned about. How do you think about sustainability, especially since data-driven Internet of Things and supply chain businesses have an opportunity to achieve operational efficiencies and track impacts like carbon, water, waste, etc.?
Yeah, I think it's an awesome question. It's actually a category I think is super interesting. So the way I think about this is my hesitation on the investment side and the business side for sustainability companies has been the lack of ability to track impact, right? So the historical example is you think about Tesla and everybody's like, oh, Tesla is great for the environment because it's battery driven versus gas driven, and there are tons of environmental benefits to that. But then people break down what it takes to actually manufacture the batteries and to actually build that vehicle. And some people say that it's actually less efficient to drive a Tesla vehicle than a Ford gas powered vehicle. I'm not ruling in on that. It's just like the framing. So to me, one of the important things is the companies I'm looking for now within that category are who is actually tracking or figuring out a way to track impact, right? So like what does impact even look like, and what are the metrics we need to be measuring to understand what is actually good for the environment and what is not. I think that's like the really important thing over the next 3-5 years that I'm hoping to see are data-centric solutions that start quantifying impact. Because on the heels of all of that, I think we'll see a lot of businesses shift how they build because they understand how to be better, more sustainable for the environment. So that's one part of it. And then I think the other part is just like consumption, right? Which is, I think consumerism exists and is not going away. So how can we be more critical about thinking about the brands that we use and their messaging and making sure that we're pushing to the brands that we care about this, right? That we care about their supply chains and we care about how they're manufacturing goods and what that looks like. So those are the two things I think in the near to midterm I'm excited about. Primarily though, really around like quantification of impact, because we don't really have that yet.
Mm-hmm. And then I have a question. How do you add your value specifically in regard to the product market fit?
Yeah, it's super case by case. So the easiest way, but it would take a while, is just walking you through from kind of like a company by company basis. But that's going to take too long. So I'll walk through like a single company in our portfolio just to explain how it works. So we invested in a company called Aspireship. They're basically a platform that helps you learn how to start a B2B SaaS sales rep. So the idea is there's massive churn on sales teams for B2B SaaS companies. They don't know how to vet talent. People end up leaving because there's not alignment between the company and the person. And so Aspireship has built a digital curriculum, about 20 hours of curriculum that you go through that teaches you what it is to be a B2B SaaS sales rep. And then they partner with companies on the back end to actually place those candidates. And I think when we started working with Corey, who's the CEO, he was focused exclusively on partnering with businesses to help place the candidates that were going through this training curriculum. And it's been doing really well from the start. And what we were realizing was that because only like 5 to 10% of candidates that started ended up completing the program, actually passing the program, and then being placed at companies, it was working, but he was leaving 90 to 95% of the potential value on the table, which were all these candidates that either didn't complete the program or didn't pass or didn't end up getting a job through the Aspireship network. And so we've been working with him to think about how he can actually help the candidates that aren't hired through the Aspireship network. And so it's thinking through that type of thing, which is, we know that there's, to an extent, the current model already works, which is get people to go through this curriculum, teach them, place them at companies. That's worked. They've made a couple hires at this point, but there's also an opportunity to further help the candidate side. And so now we're exploring what that might look like. So it's an example, which is that every company has different potential business opportunities, and we try to be a thought partner, not only in like what your core business is, but should that be your core business going forward, or how do you supplement that business, or what does it look like?
Yeah. I'm going to head to the Q&A right after this question. So what advice do you have for startups who are looking to raise another round this year?
Yeah, it's a really good question. What I would say is I would go in with an understanding that there's a lot of unknowns right now. And because there are a lot of unknowns, people seemingly are likely going to be far more hesitant than they would be in a more stable environment. So what we, again, have been telling founders we've invested in is go to people you know, right? Like go to people that you know, that trust you as a capital, to be a potential capital source, because they won't need to do the same work. And they can act as kind of a confidant and a bridge of capital if you have that. So that's advice A. Advice B is if you don't have that, and a lot of people do not have that, I think it's showing how you can be scrappy and creative in a time of change, right? Kind of what I alluded to before is that the world is changing. And again, with the recognition that what's most important now is kind of everybody's health, change and volatility does often provide way more opportunity. So in that, if you're really focused on your business, think about the changing environment and ways that you can get creative in terms of capturing value in the near to midterm. And I think if you can go to market showing like, hey, given everything happening, we've actually iterated and moved our business more quickly, it to me would be an indicator that this person is very thoughtful about the world, how it affects their business. And that's a good indicator of somebody being able to build a business going forward. Even with that, again, people aren't taking as many calls, people are distracted. So if you're in a position where you need to be raising capital, it's just hard. So I would try to think through ways to kind of like exist as long as possible while the unknown figures itself out. And that can mean like just finding small ways to make revenue that aren't necessarily tied to your core business, but just figuring out a way to exist through this process, because when we come out the other side, I believe there will be opportunity. So it's just trying to exist as long as you can in creative ways until capital hopefully returns kind of like a normal flow.
Awesome. Thanks for that. So this question comes from Jeff Wallerman. Hi, Jeff. He says, what is the best way to reach out to you directly if he feels like he has a business that resonates with your investment focus?
Yeah, for sure. So I'm open to all inbound. My email is Brian, BRIAN, @storyventures.vc. Just from a process perspective, the email you'll get back from me is I'm going to send it along to the team will review. So that's how it'll work. And feel free to reach out with questions or thoughts or whatever it is. And I'm decent at email. I'm almost always like 200 to 500 emails behind, but I do work through it. So I will get back to you at some point.
I love it. 200 to 500. I'm just going to say 2 to 5. So this question is from Sunil. He has a company, a platform called quicker.com. It's a last mile problem platform using shuttles and autonomous vehicles. Will COVID-19 affect group transportation going forward?
It's a great question. My intuition is yes. I don't know how or what that will look like. I think generally part of the reason that our portfolio is a bit insulated is that a lot of what we invest in is around automation. My sense is that coming out of this, there will be a continued and increased focus on automation, right? So if you think about trucking and last mile delivery, there were maybe a few folks that were thinking about, there are companies like Starship out there that are doing like last mile on sidewalk delivery. And I think we'll see kind of a reemergence of energy around that, which is in an environment where people don't want to be interacting or touching, are there ways to get product from place to place by removing the people in some capacity for safety purposes or the like? So I think there's opportunity around supply chain and logistics automation. There's the flip side of that, which I think is important to address, which is like that is also automating away labor, and that is an issue. So those two things are at odds, but there are pros and cons to that. In terms of shared mobility, my gut is that like it's kind of a necessity, right? So some people don't have the option to travel in different ways because of cost. Some people choose it because of convenience. So maybe it's that we see solutions around improved cleanliness within those environments, which is maybe hopefully companies that are focused on how to make subways cleaner or how to confirm that an Uber or a Lyft is sanitary or whatever it is. But I think people need it to get around, right? Like people still are going to need to move around. So my sense is like that market is still going to exist and there's still a need for it, but maybe we see solutions to help calm people's fears around the cleanliness of that environment.
Mm-hmm. Mm-hmm. So I have this question, it's anonymous. Could you talk about what is over-the-air software and have there been advancements looking to use the software in a consumer products tool?
Sure. So I'll preface this by saying I'm not technical, but I'll do my best here. So the way, as I understand over-the-air software, I think the easiest concept of it is thinking about like Tesla. So Tesla has has a computer system within their car, right? And because they have that, they can send updates to their vehicle, right? So say they want to change their infotainment system and the user interface of that. Historically, a Ford or a GM vehicle could not do that because they didn't have any way to pass information to their vehicle. Tesla was the first company at scale to do that. And so you can send these OTA updates, which are over-the-air updates. I think my sense on the broader space, vehicles and the like, is that this will be really impacted by the IoT ecosystem, right? So as we have more devices that are connected, that are online, we'll have more devices that can accept OTA updates. And that's a really interesting space. So I think OTA updates and software around it, similar to cybersecurity specifically related to IoT, are interesting because they'll grow as we see more connected devices. And so if I were in that space, or as I spend time in that space, it's getting a sense of like, how quickly are we seeing new connected devices scale? What's the software they're using to enable things like OTA updates or cyber protection or whatever that is? And if there's an opportunity there, great. I think we're probably 1, 3, 5 years out from seeing like a pretty large growth in connected devices, which means that there probably is an emerging ecosystem for the OTA category, for the cyber category.
Mm-hmm. Mm-hmm. This question is from Gwen. Does it make sense to fundraise from investors/angels as opposed to friends and family?
Again, case by case. The way I think about it is for institutional investors. So for investors like us, we're looking to drive financial returns. We have a diversified portfolio. Generally, what we're underwriting is we're looking for opportunities that we believe can return 20x plus. Now, that's not to say that it will. That's obviously not the case, but that is what we're looking, which is, say you're valued at $10 million post money. We're going to take about 50% dilution through that. You should be able to sell for $400 million plus to justify a investment from us. That's just like a framing of the market opportunity. The reality is that a lot of businesses that are created aren't built to be multi-$100 million businesses. So I think the first thing to think about is like, what is the type of business you want to create? If you're looking to create a really large business, I think it's great to go to institutional investors. And then the question is, do you go to institutional investors or do you start with family and friends? I think if you start with family and friends, the reason to do it is because you have that network. That's where capital comes from. And I think it can be valuable, but it's important to be transparent with those people, which is like, what are you thinking in terms of what you want to create, what the time horizon of that is? Because I think those people trust you inherently. And so you want to be really diligent about accepting that money if you do so, because they're doing it often out of trust for you. So I think reason to go to friends and family is it's earlier stage. It's really idea stage. You don't know investors that necessarily will take the chance at that time, but just remember that if you're taking money from family and friends, it's a testament to their belief in you. And so you want to feel really good that you can represent their capital well and drive returns.
Mm. I have another question that's anonymous. I'm going to try to get this correct. So they said, what are your thoughts on startup valuation based on revenue and product margin and growth and scale versus value built on consumer behavior data and insights?
Yeah, super nuanced, super interesting. Again, it's like super case by case, particularly depending on stage. I think I'll try to answer this high level because I don't think without knowing more, I can answer it in detail. I think the things you're looking for are revenue growth, margins on that revenue, and expansion opportunities on that revenue, and the moat around that business, right? So probably like limitations on churn, things like that as you grow your business. So those are probably like the four axes that come to mind as I think about it. And there are all different calculations to factor that in. I think the reality is, depending on the type of business you want to build, if you focus on those things, which again, I'll repeat, are revenue growth, margins, kind of moat, so stickiness of the product. And I said one more, I don't remember anymore. But if you focus on those, some combination of that will be an indicator of kind of like the size of the business, the speed with which it'll grow, and like that's what the metrics folks will be looking at for.
This question comes from Vishal. He said, will there be any way to deny OPT update?
Candidly, I don't know what OPT update is. I could look it up.
I don't know either. Sorry, Vishal. Can you tell us what it is and we can try to answer that?
Yeah, I'm not exactly sure what he's referring to.
So I have a question from Amira. She wanted to know if you had any recommendations for crowdfunding. I don't know if you've ever dealt with a client that has done that, but a crowdfunding site for someone that's just starting to raise and they have a product developed.
Yeah, I haven't done much in the crowdfunding world. My general sense from speaking with folks that do is that marketing is just really important, right? So figure out the different crowdfunding sites. And I think it's similar to, as you think about like Google or Amazon, it's how do you make sure to get your product to be top of mind and to get feedback on quality. So I think I know that there are like crowdfunding consulting firms. So I think if you don't know, maybe try to find a friend or a person that can put you on contact there to get a sense of how they do it. But I think goal is marketing, which is like, how do you get to the top of whatever crowdfunding site you're posting on? And how do you make sure that you're getting feedback on the messaging around the product? Because it's really kind of just like a search engine product. So that's what I would think about. And then there's obviously nuance like selling the product, but that's high level.
So this question comes from Chelsea. Thanks, Chelsea, for restating that. And let me know what kind of business you have, actually. But Chelsea says, we are confident we will be able to exist during this time, as you said, to try to do, but we are worried we won't be able to meet target growth rates during this time because sales are tough. Yeah. So when we go back out to raise, our number to raise. Our numbers will look poor, and then we won't be able to raise. For context, we are pre-seed and need capital to help us automate the back end. So going back to that question, how will you look at growth metrics after this is all over? Do you think there will be some leniency with sales being tough during this time?
Got it. That's super helpful. I think it's a great question. So I would say if I were an entrepreneur building a business, I would expect no leniency, right? The reality is that maybe there will be. I can't predict what the market will do in 3 to 6 months, but my sense in talking to entrepreneurs is that people are getting creative in terms of figuring out ways to get to where they need to be, regardless of the current environment. So like I get that revenue is down, sales are down. But if you can't be selling, then you probably can be doing something else. And so again, it's figuring out how you can get creative, and maybe it comes that time 6, 9, 12 months down the road where you need to raise and revenue isn't where you need to be, but you can make a pretty compelling case around the product maturity, right? And saying like, hey, had we raised, had nothing happened in the market, we would have had maybe double the amount of revenue, but our product was less mature. Now we actually feel that we can sell our product at a higher price because we've focused the past 3 to 6 months on development or whatever it might be. So I think if you're not going to hit the marks you want to, I would just be careful to think about how you're using these 3 to 6 months, because that will be an important part of your narrative and how you were able to kind of persevere through a volatile period.
Awesome. Thank you so much. Do we have any other questions? I do see a few, but we've already answered some of them. If I didn't get to your question, it's because I don't understand your question. So just make sure when you're typing it out that it's clear, there's no typos, so that I can read it. Thank you so much for that. So let me ask you a question, Brian. I know you talked about the advice for startups who want to raise, but is there any uncommon advice that you would give an entrepreneur just about their business in general?
I feel like I don't have any uncommon advice anymore, but I would say, I think for me, given everything going on, the advice I'm providing most frequently that I don't know if people are sharing or not sharing is like, use this time to critically think about your business and what you want to build, right? Like the whole world is kind of paused right now. And it gives myself an opportunity to think more mid to long term, right? Which is like when you're building an early stage company and the market is active, you're so focused on developing just the minimum functions you need, and you're so focused on selling. The reality is like you can't sell right now for the most part, or most businesses cannot. So I would say take some time to speak with the people you trust most, knowing what you've learned over the past 6, 12, 18 months of running your business, and use this time to critically think about what you want to create and how to do that most efficiently, right? Like my hope is that we come out of this with entrepreneurs that recognize the importance of capital efficiency and kind of like over preparedness given uncertainties and macro impacts that we don't have control over. And so I'm hopeful that we can all use this as a learning lesson, which is that like there are going to be external factors that meaningfully affect us. And how do you build a business to mitigate that type of risk? And how do you build the type of business you want to, which is like maybe you're spending time at home and you really enjoy that. And maybe you don't need to work 16 hours a day, or maybe you're going crazy in your home and you want to work 16 hours a day. But I think use this time to build alignment over what you want to do for the next 3, 5, 10 years. Because starting a business is really hard. We're like 5 years into a fund now, and I've spent a lot of time over the past few days and weeks just reflecting on the fact that 5 years of my life have gone into this, and it's been a lot of work, sweat, tears, some tears, and it's helpful to kind of reorient my brain towards what I want the next 5 to 10 years to look like.
Awesome. And I'm going to end on this question, and it's anonymous. How will VC mindset and focus shift within 12 to 18 months if we sustain an economic recession?
So I think there's 2 parts. One is what activity is happening in the actual market, right? So if we're in a sustained recession, but people are moving around the world, people are able to buy goods and go back to a level of normalcy, then I think we'll at least have more information on what products are being bought, where there's appetite. So I think we'll have kind of a realignment around, or we'll go back to the traditional way of evaluating a company, which is like, how are you doing on sales? Because recession or not, the thing that matters is like, how are you able to sell your product? What does that messaging look like? And so that I think will normalize a bit. I think the unknown is basically like, if we see a slowdown in the economy, then people are buying less and companies are buying less. So it means there's that much of a higher bar for your product. And I think the second thing, and probably most important, is that VCs are capital managers, right? So we manage capital on behalf of LPs. And what's going to be very interesting is how our investors start shifting their strategy, right? Like if one of the notes or one of the things people are discussing is that LPs have to manage a diversified portfolio. If their equity portfolio shrinks, then there's a good chance that if the market doesn't correct, that their private assets, being venture capital, private equity, need to shrink as well. So it might be that we see less inflows of capital from LPs to venture capital firms. And if that happens, it means that there's less capital out there. So I think the large unknown is, are we going to see a shrinkage of capital for the venture community, for the private equity community? If we do, that'll have ripple effects throughout the entire industry. So that's the unknown. I think the known is, if we get back to a level of normalcy, it's status quo, which is like build best product and prove that people want it, and people will hopefully invest in that.
Yeah, I know I said that I have one more question, but I have one more. So Jeff, I see your question. I'm going to incorporate it into this, and hopefully it answers yours as well. So the founders and companies that you're working with, how are you advising them to work with their team as far as layoffs, furloughs, motivating the ones that are there? What kind of advice are you offering them?
Yeah. Again, case by case, but I'll kind of try to answer it broadly. So depending on the type of labor you have, there's like a massive impact here, right? If you have a lot of hourly workers or workers that are in physical locations or whatever it might be, it's very different than if you are building a full digital software product, right? So I think the folks that have a longer tail of workers, larger organizations, you want to do everything you can, but the reality is like, you need to be able to support them in some way. And so you're just going to have to make some difficult decisions. I think the first thing I advise is definitely taking a deep look at everything the stimulus package is offering. Like, for example, right now for businesses with 500 people or less, the government is offering a way to subsidize at least a month of salary for anybody that makes 100K or less, or basically the threshold is 100K. And you can basically get that amount of capital on a forgivable loan. And so if you can get it, you have a theoretical month to be able to employ all of those people that the government is offering up to you. So there are pathways. I think, again, you just need to get creative, right? Which is like, figure out capital sources, figure out ways to manage money. If you come to the conclusion that there's just no way to keep your business afloat without firing or furloughing employees, I think have that conversation with them and be human, right? Like, talk to them about it, talk to them about why this is happening, give them visibility into how you're thinking about rehiring them in 3 to 6 months if things change, how you're thinking about not if you just can't do it. But be a human, have that conversation. So I think those are the big things. And in terms of managing your team, I think, look, the world is not up and to the right always. Things can get bad, and as difficult as this is, there will be opportunity on the heels of this. There will be plenty to do and build. And so I think reflect with yourself, figure out whether or not you still believe in what you're building and what you're doing. And if you do, relay that to your team and explain why this is important and explain why you want them around, and maintain morale, because times are difficult, but they will get better. And so as long as you still believe in what you're doing, then keep working towards that.
Awesome. Thank you so much, Brian. Everyone, Can we please say thank you to Brian? Show him some love. Thank you, thank you, thank you. And yes, I do want to add that thank you, Wilson. That early growth we are helping people with the stimulus package. I think an email went out about that. So if you need any help trying to figure out relief loans, fill those things out, we're helping people. We're helping clients do that. Look at all that love. So awesome.
Thanks, Teresa.
Thank you so much. This was so helpful in such a time that we really need. Everyone needs a little bit more guidance on, what's the next step? What should we do? So this was really awesome. Again, to the people that asked, yes, this was recorded. So I'll be sending this out in the next 48 hours. So just look out for that email. And again, if you need help with your taxes, please reach out to us. Today is a deadline for C Corps, where you get $500 off of your tax preparation. And that's at earlygrowth.com/tax promotion. Yeah. Awesome. Well, thank you again, Brian, and everyone have a great Wednesday.
Thanks so much. Thanks, everybody.